In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged.
Now investors, news like that out of the Federal Reserve pausing interest rate hikes for the first time in the last 15 months was certainly applauded, but don't let selective hearing play a role in your investment strategy.
Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
You see, it was the second half of Powell's statement that should sound all alarm bells, as we can now expect at least 2 more interest rate hikes. So today, I want to talk about what that means for all of us, what we can do right now to avoid losing money, and ultimately come out with profits no matter what, with 7 dividend stocks to buy right now. Now, if you're new here, I'm Ari, a dividend investor here on YouTube, looking to simply help you connect the dots with all of these economic insights and then share dividend stock ideas on a week-to-week basis. But enough talking, let's go ahead and dive right in. So with headlines becoming more negative following Powell's remarks that were pretty hawkish, here we are with my account losing steam, falling back below $120,000 to $119,716.25, which means opportunity for all of us willing to bear the market momentum and just fish for discounted stock deals that are not only available to us right now, but with plenty more discount opportunities ahead. But before we talk stocks, let's go ahead and talk about what you need to know given this hawkish Federal Reserve out of what seems like nowhere. But really not all too surprising if you know your macros. You see, 2 FOMC meetings ago, Powell shared with us that we would likely get this latest pause in interest rate hikes, and we saw exactly that. Why? Well, simple. Because while the Federal Reserve would like to press on with interest rate hikes without taking small baby steps first, a catastrophic market shock could literally just obliterate all the positive economic and market momentum. Now, in other words, the Federal Reserve needs to take it slow, step by step, to see how the impact of all the previous rate hikes are impacting the market to ensure we don't see more bank collapses and the alike. However, what Powell really just did as the latest FOMC meeting was really give us everything we need to know for the remainder of 2023. After all, as I always say, Powell is not here to play poker with the American people. So for those of you who missed my intro because you think introductions don't matter,
Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
and there you have it, Powell sharing with us what we can expect, which is another 2 interest rate hikes before the year's end. Now, of course, this hawkish Fed is not just going to disappear until inflation is at least at a healthy range from their goal of 2% inflation. But now this all means that we should be preparing right now for the environment of high interest rates. And I mean rates that we really all weren't expecting, around or even above 5.6%, which would really squeeze and pressurize businesses and in turn, collectively, all of us. Now this means just quality over everything, and quality stems from companies that prevail in the ebbs and the flows of all of the market volatility, which leads us to our 7 dividend stocks that I would say are incredibly strong buys right now. Now nonetheless, first up here, let's talk about the lowest dividend paying stock on our list today, yet it is one of the strongest out of the reliability factor here. It's Home Depot, ticker symbol HD, which I know that many of you are probably already familiar with Home Depot, given it's the most popular home improvement retailer out there, with all of these DIY projects set aside, however, and construction just slowing down. Well, here we are with Home Depot down from their peak of $334 per share this year, trading for just $300 a share, with a price to earnings ratio coming in at just 18.4. Now, in my opinion, Home Depot is a real buy, hold, and enjoy dividend stock to capture at the right price. With smart money moving in on this position, loading up on shares, and even analysts who remain bullish, nearly 7% worth of upside expected, with that share price climbing to $321.06 per share. I mean, you have to keep this one on your radar, especially with its insanely safe dividend yield that is coming in above the sector average at 2.65%. Now, next up, I want to talk about a stock in the same sector, but with a different order of business, and it's actually one that I personally already bought up months back at its lows. It's Stanley Black & Decker, ticker symbol SWK, which is actually the supplier to Home Depot and and Lowe's, as well as all of these home improvement retailers out there. And it's the world's largest tool manufacturer, manufacturing both tools and power tools. Now, of course, because of the same reasons as Home Depot, Stanley Black is just discounted, trading for only $88 per share, which is actually up from about a year ago, almost 20%. So a nice return that I'm already seeing, but plenty more upside to come when the market recovers. So enjoy that PE ratio at 19.3 and get to it before smart money does, as we're already seeing smart money begin to pour more and more money into this investment. But I'll cut right to it because it's such a similar play to Home Depot that share price is not only going to appreciate over time, but of course you're going to be rewarded with their dividend, as their dividend yield is coming in at 3.57%. Now, before we get into this next dividend stock, if you are finding today's video to be of any value, I gotta ask for your help directly and letting me know by simply tapping on that thumbs up button. And now, more importantly for the both of us, to never miss a single video of mine, you gotta join me on the journey by simply subscribing to the channel. With that, let's talk logistics with United Parcel Service, ticker symbol UPS for short, which is also their ticker, and more importantly to note is just its sheer size as the world's largest shipping carrier. Now, that's important to note because as supply and demand shifts, well, we also see UPS's share price fluctuating, and we already see that UPS is down on the year by almost 6%, trading for roughly $173 per share, with a PE ratio coming in at 14.3, making for a ton of opportunity that hedge funds are already seizing. And bullish analysts, as they're predicting a share price to bounce up to $193.07 per share, making for about 11% worth of upside. And until then, we have its dividend, with a dividend yield coming in at 3.54%. But if UPS is seemingly too risky, let's keep it to one sector that none of us can live without, and that's healthcare, with Amgen, ticker symbol AMGN, being the discount opportunity to spotlight, as it's one of the world's largest independent biotechs that's developing some of the leading therapeutics on the market today. Yet, it's not necessarily seeing all of this love from investors, as it's down by nearly 12% on the year from its peak of $270 per share, now trading for just $227 per share, with a PE ratio coming in at 15.5, which is why smart money is actually swooping right in to scale up their positions with Amgen at this time, and analysts who are also bullish on this biotech, with 17% worth of upside expected, with a share price that supposedly is going to climb to $265.63 per share. And until then, shareholders are just going to reap the benefit of their 3.56% dividend yield. Next up, let's balk and squawk once more about Tyson Foods, ticker symbol TSN, which is the world's second largest meat processor when it comes to beef, chicken, and pork, as well as the largest exporter of meats out of the United States. Now, I get it. Everyone's reservations about Tyson, they're valid, especially after multiple earnings seasons without triumph, but the macros matter here. And if we recognize just how pressed Tyson is, with feed prices jacked up, trucking costs that are elevated, and overall consumer trends that are cutting back, which all has just a negative impact on Tyson, well, no wonder their share price has been sliding. It's trading for $50 a share. That's down from about $65 earlier this year, and that's that price to earnings ratio now at just 11.7. Now, yes, hedge funds are beefing up their portfolios with this meat processor, but there's plenty of upside that I think is still there well into the future, which means that Tyson is certainly a buy at this point in time, and I bought it months back. Now, until the market conditions really turn favorable for Tyson, I'm just going to kick back and enjoy the dividend coming in at a 3.81% dividend yield. Moving right along into our final two stocks for the day, let's first break down an under-the-radar flying insurance company that pays some serious dividends. It's Fidelity National Financial, ticker symbol FNF, which is strictly focused on title insurance and settlement services to the real estate and mortgage industries. Now, what exactly do our macros say about the housing industry?
I can't imagine buying a house right now at those elevated rates. What's your outlook when it comes to mortgage rates? Do you expect them to stay elevated throughout the rest of the year? And how does that impact prices? For example, Zillow says they're forecasting prices for homes to go up 5% this year. Do you agree or disagree?
And with even more pain ahead, not only is Fidelity National down right now, but it could even sink to some lower lows. And that's just because home buyers aren't buying homes, which is why we have a share price of Fidelity Nationals at $34 per share with a PE at 14. But wait until you see hedge fund activity here, with Martin Whitman at Third Ave leading the charge amongst all of these hedge funds with an increase of over 2,000% worth of a holding change, and analysts that are equally as bullish with a share price that's climbing up to $45 per share makes for about 30% worth of upside, and a beautiful dividend yield to cap us off at 5.17%. Now last but not least, investors, I'm going to present you with Dow Chemical, ticker symbol DOW, which is among the 3 largest chemical producers in the entire world, with a presence in over 160 countries, and with their chemicals used across industry verticals, whether it's in adhesives, foams, opticals, silicones, and much more. It's about supply and demand here, and therefore the stock is wavering, though it is performing on the year, but it's only trading for $51 per share right now with a PE at just 13. And of course, smart money has been all over Dow, along with analysts who are favoring the future for Dow, coming up to a share price of $56.23 per share. It's nearly 10% worth of upside, and until then, a mighty dividend yield to collect on at 5.39%. Now, you don't need to go too far here for the next video, just go ahead and tap right here. And moreover, please let me know if today's video brought you any value by tapping on that thumbs up button or dropping some comments down below. Now be sure to never miss another video by, of course, subscribing.